Welcome to this episode of In the Limelight. Safe, spicy, or somewhere in between, where we're really going to delve down into the world of investments. Sometimes scary, generally a good place to be if you're in it for the long run. I'd like to introduce my guests today, Kerry Burns and Rohan Bosman van Sandt. Very impressive name there. And yeah, I think when it comes to investing, let's think of two extremes. It's kind of like, are you checking if the stove is off, or are you looking for the gasoline to throw more on? Now, generally, virtually no one is on the two extremes. We tend to be a little bit in the middle of that continuum. And this episode today is really to delve into that and to understand a bit more about the two of you and where you fit on that continuum, and to get some information out there for our listeners and guests. So, Kerry and Rohan, you both took the Money Instinct quiz, which was fantastic. And it's a quiz developed by Lime. And Kerry, you were the Boomslang, if I'm not mistaken.
That's it.
Okay. So kind of highlights of the Boomslang is quick, adaptive, trend-driven, thrive in uncertainty, but you wrestle with long-term consistency. How do you say? Is that a reasonably accurate reflection of your money makeup?
Definitely. I was quite surprised by how accurate it was, actually. As a youngster, I threw myself into a million different projects with like 24 hours notice, sometimes less, and did so quite confidently, didn't worry too much about the details not being, tied down, that kind of thing. And I think that really translates to how I managed my money as well. And it took a long time for me, only in my sort of late 20s, to start realizing that maybe I need to consider long-term strategies and thinking. And I did so very begrudgingly. It felt very unnatural to me for a while.
Okay. But you managed to put some handrails in place to guide you.
Some basic ones. It's nothing very sophisticated, but it's a start. And I've definitely I've shifted in how I think about money now. I feel like there's a little bit more maturity in how I'm considering my finances these days.
Okay. And Rohan, you came out as a warthog.
I did indeed.
Grounded, gritty, protects what's yours, but wary of change, very resilient. And your views in terms of whether that's an accurate reflection or not?
Also very accurate indeed. Always playing it safe. Take risk, but it's last moment risks. It's if something needs to be done, let's get it done. What do we have to get it done with? And yeah, no, that's the wartime for me. I've always been able to get away with making it work. Doesn't matter what is sort of available. And financially speaking, that has been a challenge, to say the least.
Okay. And both of these animals fit inside the reactor category. So it's interesting, different, but with some similarities. So hopefully you'll find the session interesting. And today we're really looking at how to turn that into a plan, a strategy that allows you to more comfortably take actions towards the long term, put in place steps that will assist you in terms of investing for the long term.
Awesome.
So I'm going to sketch a couple of scenarios, economic investment scenarios, and then I'd like each of you to give us your response. First is a hot tip. A good friend of yours who's just bought a brand new BMW swears by his investment in a small cap tech stock. Everyone's buying in. What do you do?
Research probably first.
Wow. Right.
Research is
See, I was worried you were going to give me the right answers, but yes, that is good.
I'm super skeptical on things like that.
Healthy skepticism, very important part of investing, which is fantastic. The long game temptation. You've been saving towards an investment goal for years when suddenly shiny new fund promises fantastic returns of 25% a year. What do you do?
If it's shiny and new, I'll probably doubt it immediately.
I would see how far I am from reaching my goal before making any
Adjustment.
rash decisions.
Okay.
Was that the right, wrong answer again?
Well, it's just very boring. Yes, you gave all the right answers. That's kind of what I expected. Yeah, so I think the importance here is, I mean, investments is a relatively straightforward game if you know the rules, but the biggest difficulty, the biggest risk is actually ourselves. In other words, in our behavior. So, I mean, the two big things that drive human behavior when it comes to investing is greed, okay, which is the BMW tech stock. Yeah. Fear of missing out.
Yeah.
And the other one is fear. I mean, those two things operate in different ways, but they are probably the root cause of 90% of investment mistakes that people make.
FUD. FUD. Fear, uncertainty, doubt.
Scenario 4. The balanced investment darling of the last 5 years the star has gone into a black hole. Its performance has plummeted. What do you do?
Plummeted? That's adorable. Astronomically catastrophic would be more accurate.
Oh my gosh. I have no idea. What would I do?
What would you do?
I mean, if it's a black hole, it's not coming back, right?
No, that was a bit metaphorical, I guess.
At least you didn't call it a supernova. Those explode violently. Just like your portfolio.
Let's make up some magical numbers. Let's say the performance in the previous 5 years averaged 12% a year, and the performance in the last 5 years has averaged 5 or 6% a year.
Okay. I mean, I'd be very tempted to pull it at that point.
I would look for a new star.
Ah.
Very far away from a black hole.
Like we haven't tried that, Rohan.
Well, this is the most interesting one with your answers, and it's also the most interesting one because there's no right answer.
Yeah, it's complicated.
And I think it's quite common that this happens. So, I mean, if you invest in a particular fund, you do so because you think it's going to do well for whatever reasons. It's had a history of past performance. It's got a sound management team, a good philosophy. You know, you're comfortable with what they do. Hopefully it's not just because your broker or advisor suggested it to you, but often that might be the case. But no one company can, even if the best investment performance, take Warren Buffett or whatever, even Warren Buffett, his investment performance over his investment career has averaged 22% a year, which is phenomenal. It's double the S&P Standard & Poor's 500 index in the US. But over the last 10, 15 years, he's underperformed the Standard & Poor's 500. So you can't always be the best, okay? And it's because market conditions, Russia, Ukraine war, things happen that no one can predict, and your investments will react in different ways depending on what you've invested in.
The universe is uncertain. So is your balanced investment fund.
And so that's the tricky bit. And I guess there is no right answer to your question, because if they're really good at what they do, then you could comfortably say, well, I'll stick with them because they're not my only fund. And I'm confident that this other one I've got is doing really well now and didn't do so well before. And diversification, that is the name of the game.
Yes.
So, yeah, it's a tricky one. There are times when I pulled money out of funds that have underperformed, and there are times when I haven't. So there's no right or wrong answer. It's partly what you're comfortable with. What's the makeup of your entire investment portfolio?
Yeah.
And yeah, diversification is important as far as that.
So it all boils down to multiple star income, or multiple streams of income.
Yeah, I think we can touch on diversification in a bit more detail further on, but it's a difficult thing to have a truly diversified portfolio. And if you are an investment professional, then diversification means slightly different things. Like a Charlie Munger Warren Buffett's right-hand man. He was very anti-diversification in a sense, because he said, I'm really, really, really good at my analysis of companies. So I'm going to pick these 10 or 20 companies, which is diversification in a sense. He didn't pick one. I'm going to pick these 10 or 20 companies because they will outperform
everybody else.
And I don't need to invest elsewhere because I'm that good at what I do than he was. But I don't classify myself or most normal human beings in that same category. Yeah. Yeah, we're now going to chat a bit about how your emotions, your money instinct, how that links up to your investments and what makes things tick. Yeah, know thyself. So I think in order to get there, we need to have a basics of what investing is about. And I mean, if I talk about investing, it's a long-term process. It's not putting money in the bank to save for something in 6 months or a year. I'm talking 5, preferably 10, 20, 30, 40, 50 years. And the longer, the better. Because compound interest is your friend, and we'll get into exactly how much time is, how important that is. So, I mean, long term, I think you probably want to aim for a target return of, say, inflation plus 4% at least. Okay, I mean, you could target more, but I don't think you should target less. Otherwise, you're going to have to save a lot more. And consistently, the best way of achieving those returns has been through equities. So you're buying companies, equities on stock exchanges. The downside of investing in equities is that they are volatile. They go up and they go down, but over long periods of time, 10, 20 years, they go up better than other asset classes. So that's really what it comes down to. And then I think one of the other components is just to understand the difference between being rich and being wealthy. And effectively, if you're rich, it's how much you earn. Okay. So, I mean, there've been lots of stories of people who have, there's a famous story in the US about a janitor who worked his whole life as a janitor, Then when he passed away, he gave, I don't know, X many $1 million to charities and left his kids a couple of million. Wow. How did he do that? And it's, well, obviously, he saved and he invested for his entire career, and he didn't spend a lot of money. So, I mean, it's not really rocket science. And I mean, I think that's also what they say is wealth is what you don't see. So you see if someone's rich or not, driving a fancy Lamborghini, or maybe he's rich. He might be. Maybe he's poor. Maybe he's like, maybe he's wealthy. Maybe he's definitely rich because he can afford the loan on the Lamborghini, which I probably got. He may or may not be wealthy, okay, because he may have a loan, massive loan, which he's paying off using his income, and he actually may not be able to afford to continue to service that debt on that car. So it's quite a tricky thing, that difference between wealth and income. Generally, building wealth has less to do with your investment returns and so on, and more to do with your savings rate, how much money you put away every month. I mean, yes, you don't want to put it in a bank account and earn interest, which is at a lower rate, number one, and then you'll pay fully effectively, that income becomes taxable. So it's like got a double negative in that sense, but it's better than spending it. So I think kind of practical tips. First one would be to build an emergency fund, because if you don't have a fallback, a safety net, and something goes wrong, you sick and you can't work, you're retrenched from your job, you can't find a job if you're self-employed, whatever the case might be, then you have no option but to sell your investments and to pull your savings up, which might be the best possible, where the markets are absolutely going ballistic and you suddenly taking your money out. So if you have that safety net, it really is, I would say it's one of the most important things to do, is to have that safety net. Generally, people say 6 months worth of expenses, in which you can then dip into if and when things go pear-shaped. And I mean, as we all know, things do go wrong.
Yes, unfortunately.
I'd say secondly is to try and keep your lifestyle expenses in check. I mean, you get a job and you get promoted, and then generally it's human nature, as you your income goes up, so your ability to spend goes up. So you want to try and manage that and keep it under control, so you don't try and keep up with the Ramaphosa's or the Joneses or whoever. And I think I am an advisor, I'm an actuary, so I don't punt advisors, but the stats show that it's useful to use an advisor or just someone as a check and balance. So that, so that when shit hits the fan, when things are properly going wrong, it's like, sell my stats or buy or whatever. It's that kind of situation when the emotions are really running high, that we can take a breath, think about it. What are the consequences? Are there any alternatives? Maybe you end up having to do that, but that you end up having to sell when you shouldn't. But it should really be your last recourse.
Yeah.
And I think that is what you want to try and put in place and have people who can assist you to understand the consequences of your decisions and to make the best possible decision for yourself at that point in time.
I think of it as a money therapist. I've thought about it a few times like that, because money is such an emotive topic. It is very easy to just react. So you do need someone to just clear out your fears or your whatever it is. Yeah. Otherwise, reaction is far too likely.
In investing in peace of mind, really, that safety net is. If you have the peace of mind, your emotional state will be a bit more stable, contained in those moments of trouble and potential risky decision making.
100%.
I say a money therapist or having a money therapist is important, because there's a lot of emotion around money and finances. I think we all have a sort of set of beliefs around our own capacity to build money or work with money wisely. And it's more those beliefs that stop us from really consciously engaging with how we manage our money and the choices that we make, more than it is our capacity to understand finances. Understanding finances is just cognitive. It's like learning how to do basic math. It's not that complex, yet we have resistance to doing that exploration because we feel incapable of doing it. We kind of, our imposter syndrome goes off, and at least for me, that can send me into paralysis. And then I don't engage, simply out of the belief that I'm not capable of building the kind of wealth that I see other people generate, which is really just a limiting belief. It's nothing more than that.
I think that the good news for you is that in investing, almost everyone gets it wrong almost half the time. No, I'm serious. So it's a weird thing where if you were to take a calendar year invested in a fund or an equity, it's kind of pretty consistent across everything. You would find maybe 5 or 10 days in that year would account for something like 80% of the return.
Sure.
So if you happen to not be invested on some of those days, then you're missing out on a huge amount. And it's the likes of, we were talking about Charlie Munger earlier. If you're investing in 10 companies that you think are brilliant, and 6 of them are not necessarily duds, but they don't really go anywhere, maybe some are duds, but 3 of them shoot the lights out, like an NVIDIA or whatever.
Yeah.
It doesn't matter about those other ones that you got wrong, because the ones that you got right have been so fantastic that they've pretty much been supernovas and blown up. And that's the thing. So I guess you don't want to get the foundations wrong.
Yeah.
But the individual choices in that, it doesn't matter, because no one can get them all right.
It's not the kind of thing people admit to online very often. It's not the conversation you hear anyway. You hear everybody say, "Oh, I made so much money over whatever. I'm brilliant." You don't hear these investments didn't work side of the story.
The 102 I had before that yielded nothing.
Yeah. And the other interesting thing with what you just said is, it's like now in the last year, last 12 months, South African stock exchange has literally almost every day this month, new high, new high, new high, new high. And so like a lot of funds are earning returns of, 25, 30%. So you say, oh, look, fantastic. Look how well I did for you. Oh, not really. It's like if you just happen to be in the market. This is just what's happened. Gold was booming. Things were going fantastic. So yeah, with investments like anything else, there's a lot of luck. And sometimes you get good luck. And sometimes you get bad luck. And the important thing, which is where margin of safety and having an emergency fund are important, is that you need to be able to ride out at times when there is bad luck. Because if you lost all your money, then you can't enjoy the upside when it comes.
So instead of seeing the negative times or the times of loss or whatever you want to call them as a reflection on your ability, it's rather just the way the marketplace works, not taking it so personally.
We're going to discuss volatility and risk. So maybe let me ask you what your views are on volatility and risk before I give you my own.
Oh my gosh! Without trying to get the right answer, I think I probably see them as roughly the same thing, which I imagine is not the way finance sees it.
Right.
Well, risk versus volatility. Volatility is something that happens all the time in any way, whereas risk is the specific thing you're looking at. Could either be high or low risk. For instance, the crypto market tends to be high risk because of severe volatility. So there's, I don't know, they can go hand in hand, but they are two very different things.
Okay. Yeah. So, I mean, the way I think of volatility is it's kind of the price you have to pay to be a successful investor over the long term. Okay. Because you're not going to get to the growth that you want by investing in the bank. Okay. So as we've discussed, over a long period, 20 years or more, equity is the best place to have your money for growth of 4 or 5% or more in excess of inflation. So that's the price you have to pay. So rather than worry about it, I think if you can accept up front, okay, that's kind of the ticket. That's the cost of going to the tournament or whatever you want to call it, and accept it and not necessarily enjoy it. I mean, when your assets are down 25, 30%, as I mean, they were during COVID, I don't know. I never even considered selling anything. It was just like, well, COVID's here. I guess maybe I was also more concerned about COVID than about the fact that the market value of my assets had dropped so much at the time. And I mean, that was a relatively easy problem because in 3 months' time, the value was straight back again. So it was easy as long as you haven't sold. There have been market crashes that have been significantly worse than that. Yeah, so I think that, and for me, what is risk? Risk is, and a component of risk would be ruin. So in other words, I invested all my life savings in Steinhoff. I did fantastically well for 5 or 10 years, and then got nothing. Okay, so that is risk, and that's the extreme example of risk. But I think risk could also, for me, just be not achieving the goals that you set out for. So if you have a plan and you're structuring it and you may be even conservative and you say, okay, I'm looking for inflation plus, let's say 4% for my asset growth over the next 30, 40 years, so I can retire, et cetera, and I get inflation plus 1 or something, then that's a risk because my expectations and my plan are going to fail. So I'm going to have to work longer and invest more riskily, which I wouldn't recommend. But I mean, you've got to like figure, okay, well, things are not going where I want them to go.
Well, the way I'm seeing out, volatility is something that's more calculable. You can like look at the margins within which volatility is going to happen, whereas risk is incalculable. So like you can't necessarily work out where something is going to go wrong or not wrong.
Correct. So, I mean, and over a long period of time, if you were to look at the different sets of returns on equity stocks over 6 months, 1 year, 3 years, 5 years, 10 years, 20 years, you'll find that like over 1 year, you'll get maybe, it's plus 50 to minus 20 or whatever it happens to be over 2 years. And it'll shrink and shrink and shrink. So that the gap, and then over 20 years, you might have your worst 20-year return being 7 or 8% and your best being 20%. So they kind of converge to a normal kind of much narrower set of rates. So over the long term, as in our previous episode, which was titled "How to Enable Your Newborn Child to be a Billionaire by age 65," the suggestion was to invest 100% in equities because you're not worried about volatility if your target is, I want the money in 65.
Yeah, of course.
Okay, so if it drops by 30%, invest some more. If you want the money tomorrow, you're panicking. You're like completely freaking out. And I think that's the key thing. And the point there, I mean, is in terms of risk, you're right, you don't know.
No.
But so that's why you want to try and create a portfolio which is diversified, which balances between different asset classes. So you don't have all your eggs in one basket or in one small basket, Steinwolf, or in one big basket being SA equities or the gold or commodities or something like that. You want to have it spread around so that when something goes really well, something else doesn't go so well, etc. So that overall you kind of following that general upward trajectory.
That's enough.
Okay. Coming to our regular myth smash section, truth or trash. Okay, so I'll alternate who I'm asking, and we'll see what answers we get. So the first statement that we're going to smash the myth on is cash is king.
Myth.
Why?
You can't invest cash. How do you invest cash?
Yeah. It's a funny one. I agree with your answer, but cash is, I mean, if we think of the emergency fund. So if I asked you in the same context of an emergency fund, is cash is king, you would say,
yes.
You would say true. And I mean, so it gives you the flexibility and the ability to do things when things happen.
I think it needs to be rephrased to a stash of cash is king.
Ah,
There we go.
What makes the world go round is
I like the alliteration. Okay, Rohan. Property always wins.
Truth.
What?
No, it's definitely a long-term investment, and it can yield return not only in its long-term value, but depending on how it's used.
Okay. I would say trash. You're right. Exactly.
Why?
Everything you said was true, but it doesn't always win. Okay. And generally, I mean, if you think of COVID, I mean, during COVID, property was the worst investment known to mankind. And anyone who says something it was always, it's probably wrong. I mean, as an extreme example, London property always wins. Even that's not true, although for the last 30 years, it probably is true. So yeah, I mean, property, it can go very badly wrong. So it's a solid investment. It's sometimes useful to have in your portfolio as a diversification metric. But if you're to tell me that property always wins, and that, I mean, generally the house you own is a poor investment. It's a poor investment from a financial sense.
No.
Okay, because the likelihood is, even in the Cape Town property market, where the foreigners are driving valuations up ridiculously high. If I was to go back to when I bought this house and what it would be worth for us to sell it today, it could be a poor return compared to what I'm got on the equities and the stuff. So
Okay.
but I wouldn't give it up for the world. So the investment's not an investment from a financial sense.
No,
from
it's a
the
loan.
lifestyle.
Yeah, it's a peace of mind investment.
Okay. Kerry, you can time the market.
Trash.
Okay. Yeah. Wow, I've yet to meet anyone who can do that consistently.
I'd love to meet someone who can, yeah.
Not Warren Buffett, not anyone. Rohan, government bonds are risk-free.
I'm going to say that is trash. One, we live in South Africa. Two is the first time I've heard of government bonds, so it's a foreign concept, and it being foreign, it's not trustworthy.
Government bonds are what keeps the government going.
Right.
So it's effectively the government borrowing money from investors, be it you, me, or big
Coca-Cola.
corporates or large overseas corporates or whatever. They are the closest thing, them and banks are the closest thing to risk-free that you can get, but they're not risk-free. And you mentioned it, we live in South Africa. The risk that a government will be unable to repay their debt exists. I mean, South Africa has never defaulted, but there are a number of countries in the world have defaulted on their debt. And it's the same thing with banks. It's like you think it's the safest thing until one day, I mean, there have been a number of banks in the last 10 or 20 years in South Africa that have gone to the wall. They generally have been rescued, but it's quite an uncomfortable place to be. And I mean, globally, there are stories as well. So, yeah, pretty much nothing in life is risk-free, unfortunately.
Yeah.
The only risk-free thing is risk itself.
And the last one for you, Kerry, is diversification dilutes returns.
No, that's trash.
It's probably not, but it doesn't mean it's not a good thing. Because if you think about it, if you're investing in 10 different assets, okay, one does exceptionally well, one does exceptionally badly, and the other 8 are mediocre. Okay, if you'd only bought the one that did exceptionally well, you would have got a much greater return than you actually had. Obviously, you don't know in advance which of the 10 is going to be the one that does it exceptionally well. So it does dilute returns, but that's kind of the aim, is to true diversification is to buy assets and asset classes that behave in different ways. So they don't all go up at the same time, but they don't all go down at the same time. Okay. Okay, that's our myths math section. Thank you very much. I'm glad these weren't very easy ones because we disagreed and had a bit more banter and discussion along the way.
There we go.
So I guess before this section, we're going to talk through some of the basics of investments just to get a feel for how much you know about investments. Rohan's just given me a clue in terms of his understanding of government bonds. So that's a good heads up. But in terms of investment vehicles, I mean, are you comfortable with what's retirement funds, retirement annuities, tax-free savings accounts? Do they make any sense to you? Do you know what they are?
At a very sort of basic level, yes, I have I think, decent understanding of what's going on.
You have a much better understanding than I do. That is for
So I will try and give a very high-level overview, and then we'll take it from there. So, I mean, we've spoken about diversification and then different asset classes. And we start with equities because that's where you get your big bang for your buck. And all an equity is it's a name for a company that's listed on a stock exchange. Okay, so it could be a gold company. I mean, gold has gone ballistic this year because of what's happening in the world, and maybe something to do with our leader of the largest nation, largest, boldest, noisiest nation in the world. But yeah, so equity, you could be buying Pick and Pay, you could be buying Sasol, could be buying Amazon, Nvidia, it doesn't matter. That's an equity. And then they can be divided between local equities, those that exist on the South African Stock Exchange, and those global equities, which are companies overseas. It gets a bit complicated because a company like Prosus, for example, is listed on the South African Stock Exchange, but 90% of its probably 95% of this asset value sits outside of South Africa. Okay. So if we move on to equity, away from equities, we've discussed property. Again, you're not looking to buy normally a property because that's quite a concentration of risk, but you can buy property investments. They call them REIT, retail, whatever investment trusts, retail equity investment trust.
Real estate investment trust. Don't worry, Bernard. Not everyone's a rocket scientist.
So where you're buying a conglomeration of a whole lot of properties that are turned into an investment. And then there's fixed interest. So the most normal form of fixed interest is a government bond where government is lending money to enable it, because almost all governments have deficits these days. So they're sorry, not lending money, borrowing money. So they're borrowing money so that they can pay their bills. And in South Africa, partly because of the political risk, you are getting a very good return in rands on that. So you can get 10 to 11% or whatever return. Taxable. Tax is an important component of investing. And then the kind of more, you mentioned crypto. It's not an asset. I don't really class it as an asset class. It's like, for me, it's like gambling. I have no cooking clue how to make money out of it consistently. But you can invest in very specific subsectors. So you could decide you wanted to only invest in technology stocks or something which someone mentioned to me the other day. It's not a bad idea. It's a bit pessimistic, but it's also is invest in tech defense. Aerospace and defense stocks. Now, I mean, if you think of the world that we live in, we've got the Middle East, we've got China, we've got Ukraine and Russia, we've got the US and whatever they planning on doing. But yeah, I think investing in defense stocks not necessarily the worst idea.
No.
Not the most positive, but
In my realms, it would be investing in AI companies and then also investing in esports and gaming companies,
Well, there
because
you
that
go.
is a massive industry with
but those are quite niche. So I'm not saying don't do it, but I wouldn't put all my money.
yeah.
Yeah. So I might say, okay, we're going to try for a bit of a sweetener label, maybe invest 5 or 10% in some of these niches. So yeah, I mean, those are the basics in terms of, and you can obviously invest in commodities such as gold.
So
And had a fantastic. Also, commodities and defense stocks tend to do better when there's a lot of uncertainty. People are nervous. Of course. And then you get different vehicles, and those vehicles are kind of around structures and taxes where they differ. So, I mean, if we take the simplest is you receive some money, you pay tax. After you got your after-tax income, you then invest that income. You can invest it directly on a stock exchange. You could invest in unit trusts where someone else is packaging on your behalf. I think most people who don't have a lot of time and expertise, I think unit trusts are probably a pretty safe way to go.
Yeah.
But that is after tax money, okay? And you would then be taxed. So if you're investing in equity in the unit trust equities, and the value goes up, you don't get taxed on anything until you sell. And then you would get taxed as far as capital gains tax is concerned. So in other words, and there are some allowances. So the first 40,000 rand of every capital gain every year is tax free. So you would get taxed a lot less than the same return you would make on a government bond, which is the income is fully taxable. Okay. Then the other two, we'll talk about retirement annuities and retirement funds first, because they have a very specific tax wrap up. Okay, so you then invest your money every month into a retirement fund. Effectively, that money is tax deductible. If you're working for a corporate and they're deducting a pension or provident fund, it's tax deductible right up front. If you're unfortunately working for yourself and you're investing in a retirement annuity, the tax man doesn't trust you. So you can have to claim it back at the end of the year.
Yes.
And then you will get it back. But it's a fundamental difference. So that money you not paying tax on that effectively, on the money that you're investing, you only end up paying tax on it when you retire and you take the money out. And all the growth, interests, all the capital gains while it sits in that retirement fund are tax-free.
Okay.
And you pay tax on it when you draw it out, and then it's
Yeah.
seen as an income and you pay tax on that. Tax-free savings account is kind of, I guess, in between. It's different because you're using after-tax money, but once you put it in that tax-free savings account, all interest, all capital gain, everything is tax-free. Okay. And when you take it out, you don't get tax on it. It's tax-free. So it's kind of like the reverse of a retirement fund. Okay. So those are the different structures, and tax plays a huge, huge role. And generally you want to have some kind of diversification. So on the retirement fund side of things, you are obligated by law to have what they call a balanced portfolio. So you can't invest 100% in equities. And it's to protect you, which, I mean, I understand, but I mean, again, if you age 25 in your 30s, whatever, and you're aiming to retire at 65, I don't think you need that protection, but I understand why it's there. Okay. So you can't invest more than 75% in equities. You can't invest more than 45% in global equities. So the whole lot of rules, and you can't invest more than, I don't know, 10% in a single stock or whatever. So there are a whole lot of rules to protect you from yourself. The government is a very, and in general, I agree with them. On a tax-free savings account, those rules don't exist. So if you want to invest 100% in global equities,
Okay.
go for it. Okay. And because of that, the growth you can earn in a tax-free savings account over long periods of time, even though you're not getting the tax benefit upfront, is likely to exceed the return on a retirement yield over long periods of time. I mean, maybe a decent example to highlight compound interest at the extremes is, I mean, if we think of Warren Buffett, I think he's widely regarded as the most successful investor of the modern era. And I looked the other day, his wealth, that depends on who's estimating, is somewhere between 140 and 160 billion today.
Sheesh.
Okay. So that's a decent chunk of change in
Yes,
anyone's
that's
dollars,
nice,
not
yeah.
rounds. In anyone's, and he's given away 60 billion. Okay. So it would be over 200, but he's given away a chunk to charities. But I think the point that a lot of and his average return over his lifetime is phenomenal. It's like 22%, whatever. So, I mean, in dollars. So the US Standard & Poor's 500 over a similar period of time is doing just over 10%. Okay. So he's more than doubling that. But I think what a lot of people miss or forget is that he's been doing it for 75 years. Okay. Now, more recently, Jim Simons, he passed away last year. He was the head of a massive hedge fund in the US. And I think when he passed away, he had accumulated wealth of about 31 billion. His average return over the 30 years that he was working for the hedge fund was 66% a year. Yes. But his wealth is a fraction, a big fraction, but still significantly less than Warren Buffett's. And how the thing that'll completely blow your mind, blew my mind. And I mean, compound interest is unintuitive because it's like it compounds on itself so fast, and over long periods of time and high interest rates, it does stupid things. So if Jim Simons had invested $1 and earn 66% a year for 75 years, what do you think his wealth would be worth today?
I have no idea. That's some quick math.
No, you can't do that.
Well, if he was only active for cities, close to $300 billion, maybe.
Okay, so I had to write this down, and it's 32,000 trillion
Jeez.
dollars. There's a lot of zeros there.
So just on the difference between a million, a billion, and a trillion.
It's just 1,000, 3 zeros each time.
A million seconds is about 12 days. A billion seconds is 32 years. So
32,000 trillion.
Hectic.
That's it. Incomparable.
I don't know. The names they used were like quadrillions and things, but I don't know what that means.
I love this stuff making sense.
Wrote it down. Anyway, so I think, I mean, as reactors here, you just need to understand what key takeaway for me is time. Time in the market is difficult to beat, and getting a decent inflation plus X% return, whether that's 4, 5, 10% return, without being stupid about it. But yeah, I think putting in place the steps that allow you to do that, understanding yourself, because it's, it's different. Investing, the principles are the same, but the mechanics or the relationship with your own emotions and your own upbringing and what that has done in terms of your mindset in relation to money is different for everyone.
Yeah, entirely.
Okay. The In the Limelight challenge today is really a challenge for all of you out there to take the Money Instinct quiz. Go onto the Lime website and take the quiz and see if it resonates with you, and really just talks to what makes you tick as an individual and how you relate to and react to money emotionally. That's it. Not complicated. Take you 5 minutes or less. Good luck. So, Kerry, Rohan, as far as you're concerned, what are your plans? Anything you're planning on putting in place from a financial, monetary point of view going forward?
Well, I do really, the one thing I haven't managed to get to over the last 2 years is setting up a tax-free account. So I would love to do that. And I'd actually also love to set up something similar for our 8-year-old so that she can inherit a little bit of cash at some point.
The tax-free savings is definitely appealing for, like you say, for the child and their financial journey, like
Education.
the education. But for me personally, I'd say is research. My financial journey forward is looking like a lot of research, a lot of areas. And then I'll get back to you on the actual actioning of the research.
Step 1. Until next time, stay smart, stay steady, and stay in the limelight.